For today's video, I wanted to discuss the answer to a fairly basic question. How does a bank make money? For a bank to make money, the bank must use depositors' money to then make loans to borrowers. The interest rate the bank collects on the loan must be greater than the amount of interest they pay to the customers. So here we have a visual of a saver. This saver is bringing money to the bank. The bank is going to incentivize this saving by paying this saver a percentage. And for simplistic purposes, we'll say the bank pays this individual 3%. Now, what is the bank going to do with the money they received from the saver? Again, the bank is going to loan that money. For a bank to make money, they must generate or originate loans. Now, the individual that borrowed the money to buy, let's say, a car, is going to make payments on this car. And when they make payments on this car, they're going to pay an interest rate. And that interest rate will be on the money that they borrowed. So they will pay back an original principal amount plus interest rate. Now again, keeping this fairly simple, let's say that they charge this individual 7%. So what is the bank earning on this transaction? In this case, the bank is charging 7 and paying 3 for a real interest rate of 4%. So the bank would make 4% on this particular loan. Now banks are a part of what we call a financial system. And a financial system is a system that allows money to be transferred from and to savers and borrowers. So in this example here, you can see savers are putting money into a financial intermediary, and those financial intermediaries are then lending that money to people that might want to borrow. In this graphic, again, we have a group that wants to save money and a group that wants to borrow money. And in between is a financial intermediary. So this saver may deposit money in a bank. The bank is going to loan that money to the borrower. The borrower is going to return that money in the form of interest payments and principal payments, and the bank will pay this saver interest. But again, there must be a spread based on the amount that is paid and the amount that they are receiving. So financial intermediaries represent entities that bring savers and borrowers together in order to link them in a financial system. A financial intermediary is going to act as a middle person for savers and borrowers. And the bank, again, makes money on the interest charged to loans in excess of the interest paid to savers. Now, banks make money in other ways as well, but this is a very vanilla perspective of the banking system. So one of the questions we might have then is, why do people borrow? And specifically in this case, why do households borrow? Well, the answer is they borrow so that they can buy things they cannot afford today in cash. Now, what might they borrow money to buy? Well, most people will borrow for big ticket purchases, such as a house, an automobile. People will borrow so they can achieve higher academic status, or they might just buy something on a credit card for the holiday season, such as a TV. So these are reasons why a household would borrow money. And again, in order to have access to that money, there must be savers. Why does a household save? Well, there are many reasons to save, but we can point to reasons such as retirement, earning interest to combat the future effects of inflation. You may save money for a working savings, that is, you want to purchase something in the future, therefore you are saving for it today. Or you may even save money to fund something in the future like your child's education. But people save for various reasons, but saving is important because it allows borrowers to have access to those loanable funds. Now we talked about why households would save. Let's talk about why businesses or firms would borrow. A business is going to borrow, quite simply, to either start a business, maybe expand a business, or to invest in capital goods. So in this picture we have a business which is constructing a new factory or a new home office. But a business will borrow because they cannot afford in cash what they would like to do in terms of their business. And of course, this is with the idea that they will make more money in the future to compensate for that borrowed money.